Mics are still live, just let you know.
Good call. Thank you, sir. Got a couple things here.
Mics are still live, just let you know.
One thing I need to figure out here. Let me turn the music off. Thank you, sir. Got a couple things here.
Mics are still live, just let you know.
So, one thing I need to figure out here. Oof, man. Trying to figure out how to live stream to YouTube as well. Woo. Hang on a second, you guys. There's one thing that I do need to make sure I do that I've never done before. It's just me tonight. So you've got myself and Chuck's hanging out with his family. He's going to be doing a little, Ian, he's going to be doing a little traveling this week. And I think he leaves tomorrow. And, in the spirit of hang out with your family, you're not going to be hanging out with them for quite some time. So you might as well hang out with them. What I can't figure out, and this might come back and bite me, gosh, I hope not, is how do you turn off the ability for anyone to annotate? That part might come back and bite me. Oh, man. So mics and videos are turned off. I'm not sure how to do the whole... if we were amongst friends and family and people who didn't want to draw on your screen things. Yeah, I actually, it's an interesting thing. I know how to do everything else, but I don't know how to turn off annotations. So we'll see. We'll see. Let's see if we can get through this without actually having children screw it up. All right, what's up, party people? So it is myself, Corey Lane. For those of you guys who don't know me, I am one of the senior traders, co-founders, portfolio managers, hedge fund manager, TradersArmy.com. So it's great to see you guys here. I see a bunch of people hanging out in our Zoom room tonight. Most of the names I recognize. So great to see you guys here. Thank you. And then I'm also watching on YouTube as well. So I'm live streaming. And so if you have questions coming from YouTube, throw them in the chat box. And I'm happy to get to all the questions. This session normally runs about an hour. But because this is just an open office hours, the length of this up to an hour depends upon you guys. I treat this as an opportunity for you guys to bring your questions, bring challenges, anything related to trading, investing, short-term, long-term, doesn't matter. If I don't know the answer, I'll happily get back to you next time. I won't just make something up. I'm happy to say, I don't actually know. I'll find that out and we'll get around to it. And so this is our happy hour as well. So it's 5 o'clock somewhere, right? Now it's 5 o'clock most places, except maybe Hawaii is still a little bit behind. But I'm coming at you from California, so it's 5 o'clock here. So hopefully you guys are having a great day. So kick this thing off with any questions that you have. Use the chat boxes, YouTube or on Zoom. And let's have, I'm sure we're going to make this one. I think this is going to be, we look to make this productive. So whatever you guys want to talk about, let's talk about it. Now, one thing that I'm going to bring up while you guys are thinking about your questions, don't everybody ask your questions at once, is some of you guys hang out with me in the option trading rooms at Traders Army. And this tool that I'm going to show you guys is something that I actually was working on this morning with you guys that were in the trading room with me. And it's like a, somebody asked me this morning, what's your maximum, risk reward that you'd be willing to take on a credit spread or selling puts or something like that? what's your maximum risk relative to reward? Anytime you're selling options, especially out of the money options, more times than not, you're going to find that the risk is greater than the reward. And that's okay because of the non-directional bias you may have and a higher probability of being right in a trade like that. However, we can't just accept any old risk reward. We have to still set up a risk reward environment that is tolerant to our historical win ratio. And so I have customized a tool to help answer that question for everyone. So I mentioned I would try to get it done today. I think I got it done today. I'm going to upload this to the website, but I want to show you how you guys can be using this one. And this one I built specifically for selling options. So most of you guys know that Chuck and I manage and run a hedge fund. And so in that hedge fund, we are utilizing short option positions, short puts, short call spreads, short put spreads when necessary, which have an increased level of probability attached to them. However, if your win ratio starts to suffer, we need to change a few things about it. We can't just stick with one plan. This is where your trading plan is only as good as your consistency. And so when we talk about consistency, selling options has a higher probability of making you money than buying options, just from a statistical standpoint. Because if you have an option that you're buying, or a long stock position, or a long futures position, or short stock, or shorts futures, you're going to have a very directional bias, and the stock needs to move in your way. The underlying, whether it's futures contract, stock, whatever it happens to be, the underlying needs to move in your direction in order to make money. Whereas when you're selling options, the underlying does not need to necessarily move in your direction to make money. You can be wrong, even by a little bit, maybe even a lot wrong, and still make money selling options if they're further out of the money. And so, yes, that's right, Vincent. So I did remember that we did have a prankster direct messaging other members in the session maybe a month ago. And so what I did is I turned it on so that you can only message the host and co-host. So you can't message one another and start a bunch of crap, right? And that's in our Zoom session here. On YouTube, again, just kind of still watching that, making sure I don't have any questions over there. So yeah, so that's just in Zoom. So when you actually text a question in, it's going to come to me directly. You guys all can't see it, but I will read the question off so that you know the question that came in. So this particular spreadsheet here, I demonstrated a little bit about it, but I cleaned it up a little bit this morning. And these two little red triangles in the corner, if you hover your cursor, you're going to be able to see that I have a little note there. And then Anjan, what's up, buddy? Yeah, let me zoom in on this a little bit. How's that? Is that a little better? That should be nice and full size, or pretty close to it anyway. Perfect. Yep, my pleasure. So on the left over here, you have number of monthly trades that you generally make. Now you could, this could be a predictive thing, like I plan on making 20 trades a month, or maybe this is on average how many trades you actually do make. It would be best if you use this is how many trades I actually do make, but we can also use this as a measurement of this is how many trades I need to make in order to hit my goals. Okay. So when you come down here to portfolio value in tan, you can anything in tan you can actually type. You can actually type in. Anything that's not in tan has a formula built in, so we're not going to touch that. And then your risk per trade. So this is how much are you planning on risking per trade. In this example, I have 0.5%, which means that each trade is going to risk about $500, which is 0.5% of a $100,000 account. So over 20 trades, the next line is, what if all of your stocks hit your stop or your short strike, or your management, price? Then you would lose $10,000 if you made 20 trades risking $500 a piece. That's what that one is, and that's 10% of your account value. So this is total risk if all stocks hit your short strike or management. And so Where do you enter the 20 trades? Mark asks right up top here. So if you have a habit of making 10 trades a month, you would just type in 10 and it would recalculate everything, right? So I'm going to keep 20 in here for just a moment. Yep. Moving down, potential profit in the trade. So this is a derivative of if you are risking. Now we're talking, I built this because we're managing short option positions in our Wealth Essentials portfolio and short option positions in the hedge fund. So if you are looking for a 3-to-1 risk relative to reward, which means you're risking 3 times your reward potential, then you would stand a chance of making $166 per trade that you're risking $500. If you are risking, I'm going to type in here 1-to-1, you're risking 500 to make 500. If you are using a directional trading style, you're risking $500 to make 1,000. I just put 0.50 in there. If you're looking at 0.33, now you're risking 3 times you stand to risk $500 to make 1,500. So you can actually modify this for both directional and non-directional trades. Now, I'm going to keep this at 3-to-1 for just a second because that's pretty common in terms of what we find in a lot of our non-directional trades, risking 3-to-1, 4-to-1, 2-to-1, things like that. So, and here's where your expectancy, how many times do you expect to win out of these 20 trades? And so in a perfect world, you are tracking your win-loss ratio. So you're seeing, a proof of you're winning, 18 trades out of 20, or you're winning 15 trades out of 20, or maybe in some cases you're winning 20 out of 20. Some cases you might be winning 10 out of 20. So you want to be tracking your actual win-loss ratio inside of this window of time. And I'm looking at this on a monthly basis as a swing trader. And in our fund, like where I'm getting this information from so far is in our hedge fund. We have a win ratio. We track this very, very closely every day. So I'll show you where we're tracking this. We're tracking this in our portfolio dashboard. And based on all the trades that we've taken since the 6th of November when we launched, we have an 89.5% win ratio over 254 trades. 43 of them are currently open. And we've got 100 and, what is that? A little over 200 trades closed. And over that time frame, we've had an 89% win ratio. Now, our average loss size is bigger than our average win size. And the question is that acceptable? Can you lose more than you win if you have an 89% win ratio? And so let me back over here for just a second. So we tend to average about 40 positions per month, okay? Now, we are risking about 0.4% of the account in any one position. Now, this in the hedge fund, it's like a $1.7 million account. So I'm just going to keep it 100,000 for a moment. And we have an technically 89.5% average win rate, and we target around 3.5 to 1 reward to risk ratio. Now, where does that land us? Well, if we lose 4 trades out of 40 and win on 36 of them, now this assumes that we just take the loss and move on. What this does not account for, and it can't account for, is X. X being when we repair or roll a position that may turn into a win next week or next month. This is just if you lose 4, win 36, close the trade, you're done. No management afterwards. So if you lose on 4 and you win on 36, your gross profits are about 4,100. Your gross losses are about 1,600. Your gross profit for the month is 2,400, and that's a 2.41% return on risk, which is a $100,000 account. Now that means that without any fees or expenses or commissions or any of that stuff, you're going to return about 28.94, a 29% return to yourself. Now, as a hedge fund, we stack fees and expenses, and there's performance fees, and there's cost to that comes with this. So we're looking at delivering to the investor a little less than that. So we have a target of delivering between 18 and 24% to the investor. And we account for that in our version of this spreadsheet, right? This is the spreadsheet that we use, and you can see that we do account for, let me refresh that. We do account for management fees, performance fees, and all that kind of stuff. So we account for all that. But since you're not managing a hedge fund, you're managing your own funds, you don't have to pay expenses or fees or any of that kind of stuff. So this would mean that you are on track if you have 40 trades risking 0.4%, and you're risking 3.5 times what you stand to make. As long as you maintain an 89% win ratio, you're on target to make about 29% a year. Now, you might say, well, I don't need to make 29% a year. That'd be nice, but I don't need to. And by the way, you may find that it's not that easy to find 40 trades. You may find that your average is 20 trades, okay? And you may find that your average risk per trade is 0.5%. And so you may say, well, I only, like, my retirement targets or my goals for the year for my account are 15% for the year. Well, if you're risking 3.5 times what you stand to make and you maintain an 89% win ratio, you're on track to making about 18% a year. Now, this doesn't include your trading commissions, but trading commissions are pretty cheap. If you wanted to assume trading commissions, you could build in a little extra buffer here. But really, you could actually risk maybe up to four times your reward potential, maybe 4.5. No, not 45 times, 4.5 your potential, and still be close to 12%. So what this does is it aims to allow you to massage on a monthly basis, keeping an eye on this, massage on a monthly basis, how you're doing, how you need to be positioning yourself, how many trades you need to be making with this average risk to reward ratio, with this average win ratio to still be on track to hit your target. Now, you may find, now by the way, does this make sense to everybody so far? Why this could be a potentially very important tool for you? Okay. Because I've had folks come to me. I started to develop this not only for our own management in the fund. I've had people say to me, listen, I've got a really great win ratio, but I'm not making as much as I need to make. And I say, well, okay, well, what's your win ratio? Well, my win ratio is about 85% of my trades are in my favor. How many trades do you make a month? Between 15 and 20. All right, so 17 trades. Win ratio 85%. What's your average risk relative to your reward when you're building out a trade? Well, for my short option positions, I'm willing to risk, up to 5 times my reward potential, right? That's what I've been doing. I think that's great for the probability of success. That seems to work. Say, okay, well, you're risking on average 5 times, or that's your limit? Well, on average about 4.5 times or 4. But 5 is my max. I say, okay, cool. So you're making 17 trades on average a month, risking 0.5% of your account. You're risking 4 times your reward potential on average, sometimes lower, sometimes higher, and your win rate is 85%. And this tells me that you should be making about 6% a year on your money. Does that sound about right? They say, yeah, maybe even a little bit less than that when you include commissions and all that. And I say, yeah, that makes sense, because that's where you're at. And they say, well, that's why I'm not hitting my target. So what things could I be doing? I put 3 things over here specifically that you could be doing to improve this and get this back up to your target, this yellow box being your target. You could, A, adjust your risk reward per trade. Okay, so maybe you've been accepting a little bit too much risk relative to your reward. So what if I bring this down to an average of 3.5? Makes a big improvement, okay? What else could you do? Increase the volume of trades. What if you were averaging 20 trades per month? You got to find a few more. I know you got to do a little bit more work. You got to put some more hours in. And now that's getting us a little bit closer, okay? A few more trades. Maybe you can find 22 on average, and that'll hit your 12% goals or whatever it is, okay? Or you could increase the risk per trade, which I put that last because I'd rather that be the last resort. I'd rather you find better quality risk reward, increase your volume of trades as long as they're not lower quality, versus increase your risk per trade. Now, if you're telling me I can't find any more than 17 on average. Well, then you may have to increase your risk reward, right? And you could increase your reward maybe to 0.6%, maybe 0.7%. This is still less than 1% in any one trade. And so you can make modifications to any or all three of these things. On a monthly basis, you can make modifications to these to make sure that you're still on track to hit your goals. And this works really well for this was designed for non-directional trades, but let's say that you are talking about directional trades. Well, you're not risking 3 times your reward potential in a directionally biased trade where you have to be right. You may be risking $700 to make $1,400. So I cut that reward potential by half. And so I type in 0.5%. So I'm risking half of what I stand to make. And so that would be a 2-to-1 reward to risk. Now, you might say, well, geez, I'm probably not going to win 85% of my trades. I probably win, if you look back at your track record, maybe you win 40% of your trades. And so I think this tool is going to really be helpful in determining how many trades you need to be targeting per month, directional or non-directional, as long as you get this box C8, tallied correctly. And as long as you're keeping an eye on your average, win, as far as like your track record for winning, this has you winning 7 out of 17 times. So maybe your win ratio is only 30%. Well, if you're only winning 30% of the time and you're going for 2-to-1 reward to risk on 17 trades, what do you need to do? Well, you need to either, it doesn't matter if you increase your trade size, that's not your trade frequency, that's not going to work. What you need to do is start improving your how much you risk relative to how much you stand to make. You can't be shooting for 2-to-1 reward to risk. You need to be shooting for, say, maybe 3-to-1 reward to risk. 3-to-1 reward to risk will get you profitable if you only have a 30% win ratio. And so what I would suggest here, Mark, to your point, you have a thing in the chat box that says, it's like we need to keep 2 different tracks going, one for directional and one for non-directional, and manage them separately. You're right about that. Now, I could technically take a little bit more time, and I will, just because it gets kind of confusing, I guess, if you have to kind of invert this. I could have 2 separate spreadsheets, and this is what I'll do, Mark, if you think this is easy. Unless you guys think it's fine doing it like this. Create 2 separate sheets, one that's for directional, one that's for non-directional. And that way your non-directional one, you can keep and say, I'm risking 3 times, things like that. But I think if you just think about this as, if this column right here is your risk, this cell is your risk, and you put 0.50 in there and you just look, I'm risking 700 to make 1,400. In fact, what I should probably do is fill in that box. Watch what I'm going to do here. That's your risk. This is your potential profit. And so you can see when you put in here, if you're risking one for one, these 2 numbers will be the same, risk, reward. If you're risking 3, you're risking 700 to make 233. If you're risking 0.25, then you're risking 700 to make 2,800. And so, maybe color coding those would be ideal, so you know which one's risk and which one's reward. But this tool is going to be incredibly helpful I'm expecting this is going to be incredibly helpful to know that, hey, I'm targeting this % return per month. I've got this account size, which means I need to make this many trades, risk reward this, and have an average win ratio of this. And if you start to suffer on any of those 3 data points, you are going to see a diminished return at the end of the year. So what this allows you to do is say, okay, last month, I really kind of screwed it up. This month, I'm going to need to target, a little bit different of a risk-reward relationship. And I need to be maybe a little bit better about picking quality positions because I need to get a win ratio that's a little bit greater than 60%. And this will help you keep yourself on track month over month over month. So I wanted to show you that. I worked on that today. So I'll be uploading that to the website, but I thought you guys might find that to be hopefully helpful and interesting. Always trying to find new tools to help kind of figure things out, right? All right, Kevin says, do you have to add each trade to that sheet? Let me see here. I answered it, but I want to read it out loud. Do you have to add each trade to that sheet or just keep track on the other spreadsheet and take those averages on a monthly basis for these numbers? Yeah, so this is just kind of your summary. So if you're keeping a journal, whether that's in TradesViz or TraderView or an Excel spreadsheet somewhere, you're keeping a journal. You want to keep a journal somewhere of your average amount of trades you make in a month, the average win loss ratio. So how many times do you win versus lose relative to the average amount of trades that you make? And once you're keeping a track of that on your journal, this is just sort of a monthly planner. Now, what I would suggest you doing, because you have an Excel spreadsheet that I've given you for a download, for Wealth Essentials and all your options trades, you're probably starting to put all those tabs down here at the bottom. So I would just download this and then just add this as a tab so it's in your whole workbook. Like our workbook for the hedge fund is all of these. It's our dashboard, it's our active positions, it's our watch list, it's our stock holdings, it's our free roll calculator, our hedge tracker, our projections, our options roll calculator. I mean, everything is in one sheet. We just have different tabs across the bottom. Okay. So I would do that. I would do that. Let me go back up in the checkbook. Can we be investors in your hedge fund? You can, Ariel. Well, that depends. The short answer is sure. The long answer is there are certain qualifications that, as a hedge fund, investors are going to have to meet. So we could talk more on that a little bit later. I could walk you through that and all that kind of stuff. But essentially, because I operate out of the state of California and Chuck operates out of the state of Texas, our states require us to only be able to take accredited investors, or qualified clients. So what does that mean? What does a accredited investor and what does a qualified client mean? Well, if you were to go to, I just shut the YouTube window. There it is. If you were to go to our website here, mainstagecap.com, and go to register, like you can't really see any information here because it's got to be behind a registration wall. So register. If you click register, you're going to see that you have to type in your name and you have to check some boxes. So these boxes will tell you, each one of these, you have to check at least one, in both boxes. And if you check the correct boxes while also being truthful, I'm not saying you specifically, I'm saying you got to be truthful, because we're technically, with the SEC and FINRA regulatory stuff on our backs, everybody needs to be truthful. So if you're like, I'm not accredited, let's say Corey Lane, I'm not accredited by any of these statements, I'm not qualified, then you'll say, unfortunately, you're not in accordance, right? But if you say, hey, I am an individual who has excess of 200,000 over the last 2 years, or joint income with the spouse in excess of 300,000, yeah, that's me. Or maybe you're worth $1 million, not including your personal residence, and maybe you've got $1.1 million that you're planning on bringing to the fund immediately, or you have a net worth of 2.2 million. You'll see that there's a registration button that allows you to register. And so if you look at these and say, hey, I'm neither of those, unfortunately, you would not qualify. If you do qualify, then you can register, and then you can log in and look at all the investor documents, the pitch deck, the tear sheets, all the PPMs and subscription documents, all that fun stuff are actually loaded on the website. But you got to register and be truthful, all that kind of stuff. We don't technically have to do due diligence, but we have to believe that you do qualify. And if we don't believe that you qualify, then we have to do due diligence. But if we believe that you do qualify, then and you check these boxes, that liability is on you. It's kind of like when you open an options account at a brokerage house and they ask you, how many years have you been trading options? If you put 3 to 5, but you've traded 0 years of options and you blow up your account because the broker assumes that you've got experience because you said you did, and you blow up your account, well, the liability is off the broker if you lied on your application. So just keep all that in mind. Hugo, can you take IRA money in your fund? Yes, but the IRA money has to be released by your broker. You don't actually, because we are using margin, we can't just take IRA money. What happens is you have to be with a IRA custodian that will release your money into private placement opportunities like a hedge fund. And so there are trust companies. We work with one called Midland Trust. Midland is their name. And we have relationships with them. We're already onboarded with them. Midland Trust. So we have relationships, so I can forward names to you. If you have an IRA with, say, Fidelity or TD Ameritrade or Schwab or something like that, they may not allow you to release those funds to a hedge fund. Pacific Premier Trust may. I have not worked with them, but Hugo, if you want to send me, Midland just renamed. I noticed that, self-directed. So what you want to do is I'll look at Pacific Premier Trust. This is them right here, Pacific Premier Trust. Okay. I'll reach out to them. If this is them, I'll reach out to them and ask, say, hey, we might have somebody, we're a hedge fund. I'll give them the spiel. We're a hedge fund. We have somebody who's got an account with you. If we onboard with you, because we would have to onboard with them as an offering, which is fine. We did that with Midland. And if they say, yeah, we can do that, we'll onboard with them, and then it'll make it easy. You don't have to do anything. You don't have to move money from Pacific Premier to Midland. But other clients in the past have had like Fidelity, and they just have to move their money to Midland. Midland sends the subscription documents, and then, all of that gets processed through Midland. And then they release the funds to be invested within the hedge fund. And so you can do it. There's just there's a little trust company that we have to make sure that we're established with for you to do that. But then, yes, IRA money is able to be invested in the hedge fund. All right, let me go back to the top because I think I missed. Vince, what's up, buddy? Says, I've been trying to trade 4-hour pivots on ES, but can't make sense of the futures options strikes. All right. So example would be, Vincent, would it be like ES? That be an example? In fact, Vincent, do you have a microphone handy? I can give you permission to unmute because I'm going to ask you a lot of questions here. And if you'd rather communicate via voice, I'm happy to do that. All right. I've just asked you to unmute.
Awesome. Thank you. Hopefully,
buddy. What's that?
I click the right button. All right. Because otherwise I get Ian saying, mics are live. Mics are live.
That's right. Mics are live. All right. So what do you got? So
let's say I'm looking to either if the ES gets up around 5,300, I want to short that, I want to put my stop above that wick over 5,310, let's call it.
Okay.
And then take a directional trade to the low side. Or if price drops to like 51.85, I want to go long. So a directionally biased trade on those 4-hour pivots, either, up or down.
And you're just like straight long, like, are we talking options here? I know we're on a futures contract, but are you trading the options on futures? Because you mentioned strike price in your question.
Yeah, I would like to figure out how to create an option trade on that price action rather than risk, 15 or 20 points in the ES.
Okay.
I was hoping I could eliminate some of my risk and not require as much capital as well.
Right.
Would be ideal.
So you're talking about maybe the opportunity to add a long put instead of being short the stock up here,
Right. Or a
or
spread trade up the top.
long
Either way. Either,
call, or
yeah.
bull call.
Right. Bull call, or, like doing a credit spread at the
Okay.
top.
Okay. So instead of saying all those words, I'm going to say add positive delta position. Because that could be a lot of different positions in options, right? Add
Right.
positive delta position. And then up here would be add negative delta position, which could be anything from short the contract outright, buying a put spread, or selling a call spread. Those are the four that you're considering, but ideally using some form of options. So you know your entry point, right? You know where you'd want your entry point on both sides, whether it's long or put. Now, would you like to automate this? I kind of know your schedule, so I think I know the answer here. Would you like to automate this to the point where if you have a situation where you're away from your desk, you're away from your office, and you want to execute one of these or the other, if either of those price levels are hit, like almost treat this as an OCO entry?
Oh, that would be golden.
Wouldn't that be
Absolutely.
amazing?
That would be, especially if they all worked. They're not even be happy. But
Well, if they all worked, you mean if you got the positive delta position first, and then it made its way to supply, and then you sold the long call spread and then entered a put spread immediately? Yeah.
well, I don't want to be that greedy, but I'll take,
Yeah.
automate it so every automated trade just makes money when I'm not even at the desk. I'd be
Yeah,
very happy with that.
true. Not sure how possible that whole thing is, but you could certainly automate things. Now, Vincent, let me ask you this. How much weight do you put on how price enters your entry area? Do you put
That's
any
why
weight on?
that's why I'm feeling pretty confident on those 4-hour pivots.
Okay.
I'm feeling comfortable.
Okay. So if price got there, you'd be perfectly happy.
Most likely.
Just enter it.
Yeah.
Okay. Okay.
Yeah.
So then we have the idea that you've got your entry price. So I'm just going to throw some entry prices up here. So we have an entry price. Let's go to the ES. I'm going to use price slices for this for a second so we could analyze a couple things. So in the Analyze tab, I got the ES here. We're going to go down here. Your entry price on the upside was roughly 52,
52.95. Yeah, that's good.
52.95, right? Let's just
Yeah.
go 52.95. So I'll type that in there. On the downside, it'd be somewhere around 52 or 51.85. Is that what you said?
Sure. Yeah.
All right. So 51.85. Whoop. 51.85. And so now is this more of a swing trade you're thinking probably? Like you'll go out, it's not just like a 1 day thing. You'll probably end up.
No, I'm hoping it'd be like 3 or 4 days moving
Okay.
from entry to target would be.
Okay. So you're probably going to be considering something in the, I mean, even if you're in an option position that's negative theta for 3 or 4 days, you'll still want, some time left over. That way you can actually sell the remaining time value back to the market and you don't have very rapid negative theta against your position, right? So I'm
Right.
thinking
Yeah.
if you went out to some, here's an end of month option. Let's just take, there's a lot of strikes on S&P.
Yeah, that's the thing that kills me because then I open some up and there's like thousands of open interest, and I open up others and there's only a few hundred, if any.
Yeah.
So I can't seem to make sense of the strikes or the
Yeah.
option series.
Well, I think what you're going to want to do here, I think you're going to want to pay attention to a couple things. Like some of these, and I wish you could just delete them altogether. But like anything that says expiration Monday, Tuesday, Wednesday, or Thursday. So these are out, these are out, these are out, these are out. So all these are out. Those are probably going to end up being the lower volume, lower open interest. And so I would look for the weekend, right? So April 24th has 18 days left to it. You could look at end of month and look and see what kind of open interest those have. But I would look at the
I'm sorry, that end of month, would that be the 19th, like the third Friday? Is that the typical?
well, April 24th, is that even the end of the month? No, that's weird. What a weird expiration date. I would try to target anything that expires on a Friday. Let's put it that way.
Okay.
Okay. So just kind of correlate your dates here. And those are most likely going to end up being the ones that carry the most open interest and volume, right? So let's take this 18-day. Let's see. This one has thousands, hundreds at least of contracts.
Yeah.
Those are pretty far out of the money. So you go at the money. I think there's some decent volume there and decent open interest. End of month, yeah, has quite a bit as well, even though falls on a Wednesday, which is really strange. Keep an eye on spreads, see what those are like here. But I would say for something you're going to be in for just a handful of days, 18 days is probably fine. I would say, and then you'll be out within a few days, probably, right?
Yeah, that's the plan anyway.
Okay. So now, when it comes to strike selection, if you're looking for a bull call spread, for instance, or a long call, you want to look at the money or maybe even a little bit out of the money. So if you're targeting 51.85 as your entry price on the long side, and you're talking, what did we say, 52.95 on the negative delta side, then you want to look at that strike price to determine which option you want to either buy if you're buying puts or you're buying the puts as part of a put spread, or which options you want to go long. So let's say that prices are going to come down to 51.85. You want to look out at the 51.85s or somewhere near there. So you got 51.80s, 51.90s. I'd honestly pick the 51.90s. They're a little bit out of the money, even if the stock is at the money. I even might pick the 5200 somewhere around a 35 or 40 delta to get a little extra gamma leverage out of it. But 51.90, and then you could say, okay, if I'm in at 51.85 and I buy the 51.90s, my target on this is going to end up being around, like, if you're picking a long call, you got to pick a target. So you'd pick your targets based upon your charts. If you're going to add a short call to this and create a vertical spread, just like any other vertical spread, you would pick an at the money option to go long. You would pick some out of the money option near your target to short. So let's say that target is somewhere around 52.60 as a for instance. You'd look up, that's on the put side anyway. So 51.90, 52.60. And if you were to buy that spread right now, it would cost you $44. Now, you're not buying that spread right now. So here's where your analytics come in. You'd only buy that spread if price came to what?
Yeah,
51.85. So here you'd anticipate buying at 51.85. You anticipate putting a stop somewhere where, like maybe below this pivot here.
Yeah, exactly.
51.66. And your target is around 52.60, let's just say 52.60. Now, if you were to buy this for 44.50 right now, and price were to go to 51.85, you'd lose $600. But 51.85 is your entry price, so you should be losing nothing. So we're not going to end up having to pay 44.50 for this. We're going to end up paying a lot less because calls get cheaper when the stock goes down. So you'll just move this down. I'm just going to click this down. It's going to take a while if I click a lot. So let me go to like maybe 30. Let's jump to 35. And I want to get this to 0. So 33, that's getting closer to zero. We should be somewhere around 32.60, 32.50 maybe. That's how much we should roughly pay for this debit spread if price gets to our entry price. You with me?
Right. Oh yeah. And what
Yeah.
what excites me about this is like 20 points of risk for $200.
Yeah. Yeah. So like you've got $180 worth of anticipated risk with your stop below 51.66, almost $670 worth of potential reward if it hits your target of 260. And you've anticipated what you can expect to pay if the S&P gets to 51.85 for the 51.90 by 52.60 call spread.
Right.
Right. Now, if you're so the challenge with automating this is how do you know you want to take the call spread versus a short put spread?
Oh yeah. I'm not
You know what I
going to be
mean?
able to see that until entry. I'm not
You're
going to be
not
able
going to be able to see which, I mean, you could say, okay, let's alternatively look at if price gets to 51.85, let's alternatively look at selling some puts out of the money. Maybe we'll try and go out to, I mean, it's going to be hard to tell where you're going to be getting the credit here, but maybe you're going out to, below this pivot and saying 51.50 short put, 51.40 long put, which right now you're not going to get a $2 credit. When price gets to 51.85, is that credit going to be more or less than $2, Vince?
I'm leaning towards the lower side. Right. No.
So what happens to puts when prices go down?
Oh, they're going much more valuable.
Puts get more expensive or cheaper when stocks go down?
Let me pour another glass of wine and then we'll get back to you. No, puts as they are falling are getting more expensive.
Oh, you sound like you're actually about 75 feet away from the microphone.
Oh, sorry. Is that much better?
Yeah, it sounded like you were talking to somebody else in the office.
Yeah. No.
Yeah, so what happens to puts? When prices go down, put prices go
I'm looking at
up.
the chart.
They go up, right?
Yeah.
So we're going to take this again to zero. So we're going to ratchet this up, okay, until that P&L at the entry price is about as close to zero as you can get it. So we're anticipating about an entry of 315. And if you look at, you're getting about $157 in credit for that. Not 315. Why aren't we getting $315 worth of credit for that? Like a stock option would be. Like if this were the SPX or if this
Yeah,
was
because the multiple is like 50, right?
the multiple's 50 on the S&P. So the multiple drops even more. It drops to half. So it only represents 50 shares of the underlying as your multiple. So that's why you're only getting $157 worth of credit. Now, would it be worth it if you got $157 worth of credit with, let's say you have a different type of stop that says, if the S&P stays above 51.50, I'll stay in. But if it drops below 51.50 at all, I'll exit the trade, right? So if it drops below 51.50, you might say, I'm risking $52 to make 157. It's a great risk reward, but you have to decide at some point, do you like the long call spread better? Where you're risking 175 to make 670 almost? Or do you like the short put spread better with a non-directional bias where you're risking $50 to $55 to make 157? So at some point, you're going to have to decide which of those two trades you prefer. Whether that's, 3 days in advance of your entry price getting hit or at the exact time your entry price is hit. But you have to decide. So now you have to decide, do I want to be directional or non-directional? But this gives you a good way of actually analyzing which has the better, more appropriate risk reward for your outlook.
Right. And I'm thinking with the 4-hour candles, it should be fine. If I get an alert, I should be able to get to a laptop or a computer.
Yeah, I mean, especially if you've kind of pre-planned these two options. If you haven't, it'll be much easier to plan them when the price is actually at your entry price. right?
Yeah.
Here, the price is not at the entry price. So we had to manipulate the potential debit or credit in order to zero out our risk at entry. That's a little bit more tedious. It's until you've done it a handful of
Right.
times, kind of confusing. So, but if you do it a few times, it's you know what you're targeting and what you're going after. It's easy to actually accomplish. But yeah, at this point, now you're kind of ready to go. You already have your plan in place because you've chosen strikes. And I think that was the question: is how do I choose strike prices?
That was my main like
Yeah,
stumbling block, was looking at all of those series of options and trying to determine which one would get me in and out in a
yeah,
pinch.
yep.
All
Greg
right,
had a
cool. Thank you. So stick to Fridays, and then
or
thank you, Corey. I
you know,
appreciate it.
something that's particularly extra liquid. And normally you're going to have your Fridays be extra liquid. And even quarterlies if they have quarterlies in here. But Greg did ask the question, Corey, why would you eliminate Fridays? I wouldn't eliminate Friday. I actually like Fridays because those are the more standard expiration series. Like your weekly expirations are all on Fridays. But with the S&Ps, they've added Mondays and Tuesdays and Wednesdays and Thursdays for all these daily expiration options, which you may choose some of those if they're very liquid and you're only going to be in for a few hours. But if you're going to swing trade them, you want something that's going to be liquid. Most times you're going to find the more liquid options actually expire on Fridays. But that's what you want. Mike, yes, this is recorded, but we don't post it at TradersArmy. It's actually being recorded and you can find it on YouTube. Mike, what's happening, buddy? Yep, you can find it on YouTube, start to finish, because we're live streaming on YouTube as well. And then Anjan says only ES is good for options among the E-minis. It's going to be one of the more liquid index options. I would say Dow, no. RUT maybe. NQ. I mean, that's definitely something you want to check, right? Is how liquid are these things? Here's your April 18th. NQ's got a little bit, but not a lot. I would stay away from NQ, especially on this expiration, which is your, weekly expiration. The spreads are $3 wide. These are huge. RUT might be actually pretty good. RTY. Let's look at the same expiration that we've been looking at, week 4. Actually, no, I lied. Those are terrible. Those are terrible. Let's look at some other ones. End of month. A little better. Spreads aren't that bad. They're $1 wide. So like a lot of these, like I don't trade a ton of options on futures because the spreads can be very wide and you'll get hurt potentially pretty severely, especially if your stop is hit in like the overnight session, European or Asian session, your markets can get really wide. So I generally would trade the index version, so the RUT or SPX or IWM or SPY or Qs, because they're all going to be a lot more liquid. But if you're dying to trade futures, yeah, I would obviously stay with the most liquid. And the most liquid is going to be the S&P because it's the most liquid contract anyway. And then, here we go. What Raphael coming in from YouTube. What's up, buddy? Hello, hope all is well. Thank you. Hope all is well with you as well. I'd like to ask in the gold futures, 15-minute chart. So GC. So we'll go to charts. We'll go to 15-minute. Bam. I don't have any lines on this chart right now, so this works. The level 2321 to 2326. 2321 to 2326. Is this a good area for potential demand? Well, that's kind of this is the area you're talking about, right? So I actually really like it. I'm going to back up on a larger time frame for just a second here. But I'll tell you why I like it on this time frame. It does represent the origin of a very strong and a strong rally in price with more than just one candle. I mean, this thing had many candles before it even paused for a moment right here at resistance. and then it blasted right through again. So I do like, actually, I don't even hate this area. The reason I don't hate that area is because it kind of does correlate with this old level of resistance. Old resistance can oftentimes act as new support. I don't like this area as much as the area that you pointed out, and here's why. If you look to the left a little bit, price did actually trade below that resistance, below it again, and so we do have a little rally here, so that could represent a little bit of a bounce from that area. But I do like your area a lot better because price has not been down to this area yet. It also correlates with a major area of resistance, resistance, resistance that was taken out. This is the origin of that move. Kind of down in here, there's two levels. So you've got this one big, let me redraw that around the basing candle there. So I'm just redrawing that a little bit, tighten that up. Kind of have two levels right on top of one another. You have this little base here before the rally, base here before the rally. So I would treat those as one. So that's a pretty solid looking area there. But the one above it, I actually do like. I actually do like it a lot because it specifically correlates with old resistance, new support. Now let me bump up to an hourly chart for a second. Yeah, I still don't dislike it. The one thing that might make me look for some confirmation that this area is going to hold is that you've got this drop, 2 hourly candles that were just sort of represent more of a base. And then price took off, but not before dropping first, then taking off. I probably wouldn't need much confirmation, but I'd like to see price get in here, start to maybe show on even a 5-minute chart, a little candle reversal. I like this whole area a lot, actually. The more I look at it, the more I like this whole area. We got a wick over wick area right here, which is basing on a smaller time frame. Yeah, I really like that area, Raphael. I like it. Does that mean that it'll work 100%? No, but I think it's got good odds, really good odds around it. Yeah, my pleasure. All right. I think I got all the questions. Wasn't it amazing how that hour goes by fast? Yeah, I think I got everybody's question. Well, any last questions before we start to wrap this up? I mean, it's been an hour. It's amazing how fast an hour can go. Well, I'm happy to take one more. Anjan, where can we find the recording? So, great question. So right now, this is being live streamed on YouTube. So you're going to want to go to YouTube, type in Traders Army, unless you've already saved it. And you'll see that this one is actually live right now. So when we're done, and it renders, it's going to be right here at the top of the list. If you're on our channel, you might find it under live, but it's probably just going to show up. It'll be date stamped. It's not here yet, but you can see the last three are all here. And so you'll have another one pop up shortly after our session is done. Mind expanding. That's the good thing. I mean, that's what these are for, right? I mean, a lot of times our trading rooms move fairly fast for someone who might be newer, so I can appreciate that. Or fast because maybe you're not, specifically all educated up in that area of asset class. And so, I like to slow it down a little bit and use these open office hours to get questions that you might not be comfortable, which I want you to be comfortable asking in any session, questions that are burning your brain up. But sometimes it's easier to feel more comfortable in a more casual environment while we're not looking for trades asking questions. So we do these every 2 weeks. So if you're on YouTube watching the recording right now, join us live. Join us live every 2 weeks, every Monday, same time, same channel. And if you ever want to check out what's going on at Traders Army, most of you guys are probably already Traders Army members. But if you're not, head over to TradersArmy.com. You can sign up for a free membership, which gets you all the on-demand content. None of the live interaction that we do each day, except for the every other Monday office hours, that's live. But all of our live stuff requires a pro membership. So go down to how we teach memberships, free. So you can check out all of our on-demand content for free. And then a pro membership is $149 a month. I'm going to type in the chat box the promo code Trader60. You should see all of these. If you're already a member, you've already used this probably, or some version, but that's a promo code that'll take 60% off your first month. So your first month will be $59, every other month $149, and you'll get just a ton of gold, I think. I mean, ask members themselves. But I think there's some good stuff that we do on a daily and a weekly basis. So there's your promo code if you want to check it out. TradersArmy.com. All right, anything else before we take off, guys? I think that's about it. All right, guys, thank you for joining us on YouTube. Raphael, thanks. Good to see you again. Thanks for participating, asking questions. And then thanks to all you guys in our Zoom room. Appreciate you guys. And yeah, if you need me, let me know. You know where to find me. All right. Peace out, you guys. Talk to you soon. See you in the trading rooms in the morning.